Hello, folks. Brandon Chapman with you today. It's another Thea Night video for Thursday, March 2nd, 2023. Man, we are approaching spring a little too quickly, although I appreciate the idea of getting warmer temperatures, being in a colder climate right here, and snowing every day this week. But if you look at the S&P 500, we still got a couple hours to the close left, or 3 hours to the close. We're coming off the lows of our session, but we're seeing over the last, couple weeks here, we are at the moment grinding lower, and unusually, this is not typical to see the VIX also fall amidst the last several days of sell-off. And so again, it's a matter of what's going on right now in terms of the broader market. And when you look at Tesla shares today, high ambition, low on details. The stock was down as much as 8%, down about 6.5% right now, but the idea, is there a master plan for the market generally and for Tesla specifically? Tesla talked about the desire to get off rare earth metals and decrease the amount of transistors used, yada, yada, yada. But what's the plan? What's the plan for redesign of the Model 3, et cetera? So we have all this stuff kind of circulating out there. And again, there's this rhetoric, the idea that somehow everything's going to come out okay for the economy, for Tesla, and all these other representative stocks. Again, what is the plan for getting us there? And the problem is the plan is right now is higher interest rates, which is not leaving the market in the best place. So again, Tesla down today, and a lot of the periphery around some of those news announcements hurting the stock as well. So let's kind of circle back here to the broader market. As you look at /MES or ES or SPX, I like to look at ETFs like the SPY. It allows me, using Trade Flash up here, you can see large prints. And what you'll notice is we've been kind of flirting with this large print from back here on January 24th. It's something I've been keying off for a while. And as we came down, it looked like we were poised to bounce off of it, even though we did put in a lower low here. The trend being more down with lower highs as well. We ended up breaking through it, retesting it, and on Monday, and rolling lower over the last several days. So it looked like Monday, if we were able to finish above it, we might kind of confirm that support, drive back to 410, 4,100, maybe 420, 4,200 on the SPX. But it just doesn't seem the case. But again, as the market's declining here, the VIX is not moving with it. And so as the VIX is falling the last few days, if we do a ratio of the 3-month VIX to the 1-month VIX, we get a sense of the outlook here. And you'll see we've come off lows. We're about 4%, meaning the VIX3M is only about 4% higher than the VIX. This is certainly not a territory where you expect to see a major sell-off. And so we're kind of stuck in this position where the market is just bleeding lower, just continue to grind lower day after day over the last 3 sessions. We'll see where we finish today, but likely lower. Maybe we finish the week lower as we approach our low from back on January 19th at about 387.50, 3,900's in there. What is the point where the market begins to break? And again, is it, a lot of speculation. Is it 39.50? Is it, 3,900? Where does that level occur? Well, again, what we're seeing right now is the climate is still pretty hostile for stocks. For example, let me just bring this up here. Where am I going? See me right here. So for example, we look at 22nd of March. I mean, right now, the expectations, 32% probability the Fed goes 50 basis points in the March meeting. And you start to jump out here a couple of months out towards July. And again, current rate's 4.5% to 5%. All of a sudden, what are you doing? You're pricing in 39%, 12%, 0.6. You're talking a greater than 50% probability we're at 5.5 or higher by when? Well, look, by summer. That's July, just as the debt ceiling's about to hit. And so what's the purpose of this? I mean, certainly we've had, today we had some data that suggests that wages are running hotter than expected. We're seeing weakness. There's this stagflationary environment that's really starting to play out over the last week. And as a function, I've taken opportunity to really focus on Monday on gold as an opportunity. In my daily sessions, we looked at some option activity in GOLD or Barrick Gold. So if I can type it in correctly. In Barrick Gold here, the idea is we may catch a bit of an oversold rally, oversold and overbought. If you use UP as a proxy for the dollar, overbought dollar. But you're seeing today the dollar rising predominantly against the euro, since that has a 57% weighting in the index. But gold today is also down. So stronger dollar today, generally speaking. Again, if the dollar continues to strengthen, that will create downward pressure on the S&P 500, and it's only going to have to recoup its value in order to kind of make up for it. But I'm not sure the market is poised to do that. As we look forward at earnings over the coming year, we're looking at earnings being down potentially upwards of 10%. Revenues are expected to be a couple percent higher. We're seeing margin compression, lower margins, lower earnings as well. And you see the backdrop here of rising treasury yields. And so treasury yields continue to rise, adjusting to those interest rate expectations. And when you think about future earnings and you discount it back to today's dollars, a higher discount rate means those earnings are less valuable. Then if you have the downgrade on those earnings, right? Lesser earnings are expected in the future and they're discounted more heavily. Now, all of a sudden, the present value of those earnings are worth less and less. And you can see the position that the market's in right now, right? There is no real plan for getting out of this because if the Fed cuts rates, what's going to happen to oil prices? Right now, oil prices are rather subdued. They're hovering near lows for all intents and purposes. We're seeing weekly inventory builds. What if they start to funnel a bunch of money out there by cutting rates too early and getting to more of the expansionary monetary policy? Well, the inflation may start to really rear its ugly head and make it really hard for policy moves in the future. So at the moment, there is no master plan, right? The Fed is keen on raising rates to tame the inflation monster. They're not exactly concerned about the downside risk at this stage. You know, Powell stated himself in his the last FOMC meeting, thinking they can get to a 2% inflation rate without a recession. Well, when has the Fed ever forecasted a recession, right? So we know that there is nobody at the wheel right now, right? There's no one that has a master plan, and maybe that's a good thing. Unfortunately, we do have the Federal Reserve, which is given monopoly power by the government. They are at the hands or the helm for setting overnight lending rates or short-term interest rates, of which IRX should follow relatively closely. And so we're seeing is that 10-year yields are rising. But notice that 13-week T-bills, 3-month T-bills are still noticeably, decent amount above the 10-year Treasury yield. And so we're seeing that spread between, short-term and longer-term interest rates tighten. But the fact of the matter is, as of today, the 30 years trading below the 10, which is trading below the 5, which is trading below the 13-week T-bill. And so at the moment, we have an inverted yield curve. So yeah, we flattened a little bit here. But the fact of the matter is we still have an inversion in the yield curve, which is suggesting that looking out, 5, 10 years plus, there's not a concern about what inflation is going to be at that point. And so at this stage, we're in a very uncertain market environment. But if we look at the volatility, we look at other volatility-based measures like the skew index, which has been declining over the last number of days to 118, there does not seem to be a desire to be hedged, but rather be long the market and not sell into. So sometimes you see that feedback loop where selling creates more selling. That's not what we're seeing right now. We're seeing a very kind of controlled falling in the price of the S&P. We're seeing the VIX fall. We're seeing skew fall. Things are setting up for a potential near-term rally. We'll have to see where this goes. And my thought process on Monday, as I was talking about gold, is that if the market does rally, it's probably going to be on the back of a weaker dollar. The weaker dollar should help promote or push gold prices higher, which would help gold stocks like GOLD, for example, and other gold names out there, AUI, all of which are very oversold in the near term. But it also may help other commodity-related stocks. Another company I reviewed on Monday, based on its option activity, was Cleveland Cliffs, which staged a breakout And we're looking at a near-term target of the prior high, maybe extending north of 25 to the 61% retracement or 261% projection of this initial kind of wave down here, correction, second wave hitting 161, next wave 261, maybe back to 34. But again, this does require a stronger economy. This is in the steel space, right? Iron ore. But right now, again, if the weaker dollar plays out, again, seeing rotation to commodities as inflation pressures continue. And so, again, this is just kind of a thought based on if the dollar starts to weaken, it may help accelerate some of these moves. Another one I think I did talk about last week as well in this video, but we did see a nice rally in BTU off of the floor in the support. This is a trade I walked through during my session. The idea of coal rebounding off lows. Had a really nice day back here in the 14th. The 2024 picture is difficult for these stocks, but the 2023 picture is improving. And again, the chance of this maybe retesting its prior high around 30. Again, looking back at the point back here is center. I looked at it predominantly because there was call activity coming in. It was at support, coming off a nice breakout day back here following its earnings. So let's keep down this kind of energy trail here. CCJ. Again, this is one that had a bigger break out to the downside back on the 21st. We're settling in here. We're catching a bid. We're consolidating. There was some bullish activity back here on CCJ on Monday. There's bullish activity on URA. And again, we're catching a little bit of a bid here, looking for this to break out, testing the upper echelon. URA, the strikes on URA were the 23 strike. Yesterday, there was some activity coming back into CCJ at the 28 strike for this week. So again, that gives you kind of this level. Do we break through it tomorrow? Does this create kind of that gamma squeeze and a retest of the prior high in the near term? So again, there are bigger problems again regarding these stocks, but we're talking about relatively oversold in the near term, a little bit of rotation and usual option activity that may help push them to retest prior highs. So the final energy stock we're going to look at here is Valero. Of course, this is a refiner, right? They buy oil and refine products and sell them. This stock did break out yesterday with significant volume, closing above the high of the 28th. We're consolidating today inside yesterday's trading range. Yeah, maybe we retest the breakout area around 136, but we look at this kind of triangle formation, the range being 25 points off of, we'll just round down to 135. That gets you to 160, okay? And today we saw a June expiration come into play at the, this was yesterday, at the 150 strike. So some of this open interest that was built here was built yesterday. And so again, a lot of volume came in. That gives us kind of a target and a time frame, 150 here. Maybe with the triangle formation breaking 150, may have a chance to push it to 160. Looking back at seasonal trends, you'll notice that 2021, we began to bottom end of December. We rallied, we consolidated, and then began to break out in mid-March and had a huge rally going into this kind of June timeframe. Began to really kind of peak here in May into June, which kind of aligns with that expiration was selected and the 150 strike here. When you look at, for example, you look at supplies. So you bringing up EIA here. We're going to come up to crude oil. Right now, production has increased a fair bit. We're at the upper end of the 5-year range for crude oil stocks. We're seeing that down here on the production side of things, we're near the record high production level, around 12.6 million barrels that we achieved back in December of 2019. So we're seeing much, much higher production levels. We're seeing inventories rise, which should suppress the price of oil, all things being equal. And so we look at gasoline, it's in kind of a different scenario right now, where gasoline stocks are well below the 5-year range. We're seeing production that really stepped up around this time last year has not, where production so far in the last month is below last year's production. We're not seeing a substantial increase. Maybe after some maintenance, maybe start to see this pick up again. But the reality right now is that the spread, and I'm just going to look at this as a ratio, /RB plus /CL. as we look at this kind of, try this again. So we look at this kind of spread, look at the yellow line, or this ratio. What we're seeing is that, RBOB gasoline prices have been rising over the last number of months relative to oil prices, similar to what happened last year around this time, which bottomed back here in October. Again, we had a similar kind of bottoming process here. We may push higher, maybe even higher, or at least remain elevated. So as we look at stocks like VLO or other refiners, like an MPC or a PSX, this may create some opportunity. The intent or the focus on Valero's because of the option activity yesterday. But again, you saw a similar move, albeit a not quite as significant volume yesterday in MPC. This is probably a better pattern and does provide that kind of 150 to 160 target area. Finally, we're going to wrap things up with bonds. So the realities of the 10-year Treasury yield rising is that, again, this places pressure on real estate. It's down, 20% in the year, but 3% in the last, a week. It's been really pushing lower as yields have been rising and kind of reflecting where the Fed funds rate's going to be here in the coming months. But also, when you think about bonds generally, there are other types of bonds. For example, corporate investment grade bonds. LQD is an example, pushing lower today. HYG is an example. Well, if I want to look at the spread here, I can take HYG plus IEI. These are two ETFs that track high yield or junk bonds, HYG, and treasury bonds, and they have a similar average maturity, or in bonds, we call it duration. And so the idea being is that has HYG underperformed relative to IEI? So if the risk spread, the risk in the market, the risk pricing in corporate bonds versus treasury bonds was increasing, this yellow line should be going down. And this generally happens as the market's selling off, risk spreads widen out. But in reality, during this sell-off in the treasury markets, HYG has basically been equal perform with IEI, meaning there's not been any increase in the risk spread. So what happens if we start to see more selling based on an adjustment in the risk spread? Because we know right now the Fed funds rate is not expected to come down. The Fed is not expected to lower rates. And as a function, short-term rates should remain relatively high. But what's going to happen to the risk spread? We look at HYG kind of breaking out of this channel, retesting the resistance and falling over. It certainly looks reasonable. We may, in the coming months, retest 71, which was the low from September, October. So as we come back in, we look at HYG, and there was some trade today, yesterday in HYG. I keep messing this up. But down here on the 73 strike, and this is previously on the 27th and first here, 5,000 contracts at 71. But the notion is, look, we're pricing in downside potential here. Now, the nice thing is with the rising volatility, you can construct a spread. Could you buy a 73 and sell a 71? Sure. It's going to cost you probably about 50 cents on a $2 wide spread. Risk 50 to make $1.50. It's a 3-to-1 spread if we get down here by April 6th expiration. You could even extend the time frame a little bit to 21st. It's not going to change the pricing much at all. But the idea is the volatility skew is benefiting buying a vertical spread. And again, low probability, but high reward, low risk trade upon a retest of 71 down there by the April expiration. Anyway, folks, so again, the fact of the matter is at this moment, we think about the master plan of Tesla, there's a really uncertain environment. I get it why maybe they're not providing a lot of details. How are they going to get or achieve these lofty goals? What are they going to do with their product line? Again, disappointing for investors. But again, the bigger picture of the broader market with an increased kind of regulatory structure, higher taxes, higher costs, more expensive energy. There's a backdrop here that's very, very negative for the market generally. And right now, it just seems that there's not much of a concern to price that in. But as we continue to inch higher, quarter point, half point, pushing towards 5.5%, at what point does the market begin to break here? Debt ceiling in the summer, worsening kind of a picture in terms of the economy, ISM manufacturing contraction. A lot of stuff is tipping. These leading indicators are tipping more negative. But as of right now, again, we may yet see the market rally before we start to reset, because right now, looking at the VIX and volatility-based measures, there's not much hedging to the downside, not much of an expectation of a sell-off. And so as a function, probably not much of a desire to sell unless we really start to break the key levels. And we're not going to know what the key level is until we start to see the selling start to come in. So expect the market to maybe grind it out here and maybe a chance of rallying next week, and look at some of those commodity-based sectors, industries, or stocks as where the opportunity may be, with a weaker dollar maybe driving that move higher, if we can see it materialize. Anyway, folks, it's been a pleasure being with you. Catch you back on next week.